Hi, I'm Larry DeBoer. I'm a professor in the Agricultural Economics department at Purdue University and an extension specialist in state and local government public policy with the Cooperative Extension Service. And I'd like to talk to you today in the second of 4 videos that we're putting together about life after recession, an update on state and local government finance in Indiana. There's a handout that goes with this talk. You can find it on the Purdue website, and you can see on your screen what the link is for that. What I want to talk about today, as you can see in the title slide, are property tax bills in 2010. And I've got a picture here of a typical property tax bill for a homeowner in Indiana, and I will confess that this is in fact my property tax bill, the tax bill on my house. And it is a tax bill, or at least it's what a tax bill looks like, even though, as you can see, it has not a bill stamped on it. This was just information about my taxes that the auditor sent me, the county auditor sent me. The actual bill went to my mortgage lender. Well, let's take the numbers off of this tax bill. So this is a tax bill on a homestead. A homestead is an owner-occupied primary residence. So it's the house that I live in, it's the house that I own. And we've got up there the date of the notice, as you can see, was April 2nd, 2010, and it was postmarked on April 13th. And that meant that the bills went out on time in Tippecanoe County, where I live. And that was true in 85 counties. The tax bills went out on time. And you might think, well, what's the big deal about that? Of course they went on time. Well, not of course. In fact, last year, only 2 counties got their tax bills out on time. The year before that, no counties got their tax bills out on time. And so an awful lot of work was done in the assessors and auditors and treasurers' offices across the state to get the tax billing and assessing system back on track after many, many disruptions that occurred during the last decade. So congratulations to them. I'm actually fairly optimistic about assessing and tax billing system here in Indiana right now. Well, what do you see on a tax bill? The top line, you see the assessed value, and this is the gross assessed value. This is the assessor's attempt to put a value on your house, and it is, in fact, an attempt to predict the potential selling price of the house. You can see that last line there, total gross assessed value of property, $211,000 in 2009, $202,000 in 2010. Apparently, the value of my property has gone down by 4.4%. This is the effect of the recession, but it's also an indication that the assessors are really attempting to take account of what's going on out there, taking a look at actual selling prices of houses in setting the taxable values, or setting the gross assessed values. And this is something new in Indiana. Only in the last few years have gross assessed values attempted to be predictions of selling prices, attempted to have any relationship to the actual market value of your homes. And that's our new market value assessment system. If we move on to the next slide, you can see the deductions. And I had a couple of big deductions there. You see the $48,000 deduction. That's the combination of the $3,000 mortgage deduction and the $45,000 standard deduction. And so a big reduction in the taxable assessed value from those two. Then comes a new one, the state supplemental deduction, which is the new 35% supplemental deduction that was created in the March 2008 tax reform. And it's 35% of the gross assessed value less the $45,000 standard deduction. And that's hard to see from the tax bill, but if you make that calculation on your own tax bills, you'll see that that's right. Take your gross assessed value, subtract $45,000, take 35% of the remainder, and that's the state supplemental deduction. What you see after you subtract the deductions is the net assessed value of property. That's the taxable assessed value of property. And for 2010, mine is a little bit more than $99,000. And what you see is that it is less than half of the gross assessed value of property. That's where the tax relief is coming from for homeowners under our new system. Not so much from those tax caps that everybody talks about, but from the big new tax deductions that homeowners receive. Less than half of most homeowners' taxable assessed value, or assessed value, is actually taxable. Well, the next slide shows the next step that we take, and that is by multiplying the taxable assessed value by the tax rate. And the tax rate is calibrated in dollars per $100 assessed value. So that 2.2079 is $2 and about 21 cents per $100 assessed value. You can also think of it as a percentage, as a little bit more than 2% of the taxable assessed value is my tax bill. You multiply that 2.2% by the $99,115 and you get the gross tax liability of $2,188. And that's down slightly from what it was in 2009. But we're not done yet. The next slide shows the credits. The first one is the local property tax credits, and Tippecanoe County and a lot of counties out there, though not a majority, have local tax credits, and it's funded from our local option income taxes. We raise money from the income tax, and we then use some of that money to reduce property taxes, mostly for homeowners, but sometimes for other taxpayers as well. Tippecanoe County's got a local homestead credit of about 10%, a little bit less than 10%, and so that subtracts $215 off of my gross tax liability. The next line is the state homestead credit, and as you can see, that subtraction has gotten smaller by quite a bit, by about 45% in fact. We used to deliver a lot of tax relief using homestead credits, which was money that came out of the state budget and used to replace homeowner property tax credits, but we've moved away from that now. With the March 2008 tax reform, we're now providing homeowner property tax relief mainly with deductions before the calculation of the tax bill and not with credits after the calculation of the tax bill. The homestead credit is phasing out, and you can see that it's phasing out. As of 2011, it will disappear altogether. The next two lines are zero on my tax bill, but they are the tax cap savings that would be on the bill if my tax bill were eligible for tax savings. And then if I were over 65, I might be eligible for another tax credit as well. But I'm not, so I don't get that one. And that gives us the total tax liability of $1,888. You'll notice that it's actually up by 7/10, even though my taxable assessed value was down. And that's due mainly to the decline in the state homestead credit. Now, I want to show you another thing that we can look at with the tax bill, and that's what would happen if my house was not a homestead but was instead something else. And if that was the case, the tax bill would be quite a bit higher. Nothing much would happen to assessed value if I, for example, rented out my house so there wasn't a homestead anymore. But take a look at the next slide and you can see that I would not get any of those homestead deductions, and so the taxable assessed value would be the same as the gross assessed value. I'd be taxed on $202,000, not $99,000. If we then multiply that by the tax rate on the next slide, you can see that the gross tax liability would be $4,462, more than double what I actually paid on my homestead. The next slide shows that I would also not get those homestead credits if I rented out my house, but I would be eligible for the tax cap credit. Taxes for rental housing are capped at 2% of gross assessed value. The gross assessed value was $202,100, so 2% of that is $4,042. And that means I would get a credit of $420 to knock the tax bill down to $4,042. Still, that is double what the tax bill would be on a homestead. If this was a commercial or industrial property, you can see on the next slide, the only change is that we are now at a 3% cap for commercial industrial property, and the homestead credit would have dropped to zero, would not have received a homestead credit. If we look at the last slide here, you can see what's been happening to tax bills across the state of Indiana. Homesteads appear to be receiving, for the first 61 counties for which we have data, a slight decrease. Apartments and non-homestead residential, those are rental housing, they're getting the big tax cuts this year because the tax caps have tightened to 2% and the tax cap credits are giving tax breaks to rental housing. Other real property, with its commercial, industrial, and ag real property, they're in the other real properties in the 3% category, so they're not getting a whole lot of tax cap credits. And in total, taxes are down slightly this year from the past. Well, that's what we have to say. That's what we can learn from property tax bills. If you can take a look at your own property tax bill, perhaps you can follow along and see what's happening with property tax policy in Indiana. Thanks very much for watching. I'm Larry DeBoer.